Want to be sure you are getting the most out of your retirement? For all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now, here's Jim with this week's Dollars and Cents tip.
3 retirement financial myths you should avoid. Number 1, the myth that you should live off your income and not touch the principal when it comes to investment returns. And that's a very frequent myth that we hear. And adhering to this strategy could really leave you exposed to inflation shortfalls. There are a couple of real shortfalls to this. So a lot of people feel like, when I go into retirement, I'm going to invest my money and I'm just going to live off the interest or the dividends. If you're invested in stocks. And the problem with that, number one, if you're saying you want to just live on the interest, inflation will just kill you. You say, well, I'll take, I have $1 million. I want to draw $40,000 a year from that. So I'll put it in CDs and treasuries and bonds. The problem is in 10 years, you're still only going to be getting $40,000 a year and you're going to be needing $60,000 a year. And so it could be very, very dangerous. The other side would be, well, I'm going to live off stock dividends. But in order to get enough income, you've got to have a 3 or 4% dividend yield. And so now you're looking for stocks that only pay dividends. The problem with all of that thinking is when it comes to funding income in the short term in retirement and then having growth of that income in the long term, what we should be focusing is total return of investment. And there's 2 main components to total return. There's the dividend or the interest, whatever the yield is, and then there's the capital appreciation. And we need both of those things over time in order to meet our needs. In the early years, I think we should live on our safe money. And that gives the risk money time to grow and have capital growth to fight inflation over time. Myth number 2, get your cash flow from bond interest and stock dividends. So this is where the stock dividends can kind of be a problem. I like stocks that pay dividends. And if you have stocks that pay dividends, especially if they're not in an IRA and you're being taxed on them, then you by all means should live on those. That should be part of your income. But we don't want to focus just on high-yielding dividends. If we had the last 7 years, you wouldn't have really had any exposure to what we call the Magnificent Seven, NVIDIA, Apple, Microsoft. You wouldn't have had exposure if you'd been thinking, I only want to have stocks that pay 3 to 4% yields. And then myth number 3, and maybe what might be the most dangerous myth, hold bonds. The percentage of bonds that you should hold should approximately equal your age. You've probably heard that. So if you're 65, you should have 65% of your money in bonds and 35% in the stock market. I think that rule was real popular when people only lived into their mid-60s and into their 70s. But with the increased lifespans today, a heavy mix of bonds will weigh down your return over time. That doesn't mean you shouldn't own any bond exposure, but because it does provide diversification in a bad market. But over time, heavy bond mix will produce a drag on your return and create a problem fighting inflation. So those are my 3 retirement myths to avoid in 2025.
That's our Dollars and Cents segment for this week. You can find this week's Dollars and Cents segment and others by visiting BroganFinancial.com.